I'm the president of the Houston Lawyers Chapter of the Federalist Society. It's a privilege to be here today. It's a real pleasure to see so many members of the Houston Lawyers Chapter here today. And on behalf of the Houston Lawyers Chapter, I'd just like to extend our thanks to Dallas for hosting this extraordinary event. It's also my honor to introduce our next panelists who are going to be discussing the 2008 financial crisis. Marc Kesselman is currently an executive vice president and general counsel at Dean Foods Company in Dallas. He was previously the senior vice president and general counsel at Frito-Lay North America Incorporated. Before joining the private sector, Mr. Kesselman served as general counsel of the United States Department of Agriculture from 2006 to 2009 and as deputy general counsel in the White House Office of Management and Budget from 2004 to 2006. Mr. Kesselman also served as senior counsel in the Office of Legal Policy at the Department of Justice and as a trial attorney in the Civil Division. Keith Hennessey is currently a research fellow at Stanford University's Hoover Institute. He served more than 14 years in economic policy roles, advising senior elected officials, including for a time as the senior White House economic advisor to President George W. Bush, as deputy director and then director of the White House National Economic Council. Mr. Hennessey coordinated economic policy, design, and implementation for the president. During the final 13 months of his time in the White House, Mr. Hennessey advised President Bush on the administration's response to the financial crisis. In that role, Mr. Hennessey was deeply involved in the 2008 economic stimulus, the reforms of Fannie Mae and Freddie Mac, and the decision to provide loans to U.S. auto manufacturers. Mr. Hennessey has a master's in public policy from Harvard's Kennedy School and a bachelor's in math and political science from Stanford. Please join me in welcoming them.
Great. Thank you very much, William. Really appreciate the introduction. Thank you very much to the Bush Center and to the Federalist Society for inviting us. I'm not quite sure how they asked a milk lawyer to run a discussion of a financial crisis back in 2008. But with Keith here, I guarantee you this will be a really interesting and lively 45 minutes. So first, Keith, I want to just take a few minutes and let us all get to know you a little bit. And I'll try not to make this feel too much like Oprah's couch. But we're a room full of lawyers, so we need a little bit of help on your background and what drove you to be an economist.
Okay. Well, thanks for having me here. I'm a big fan of both milk and Fritos, but not together. And I'm actually really excited to be at a Federalist Society event. I was always a little envious, and I teach at a business school, that there is not a similar organization for folks committed to freedom in the business school world, so I was always a little envious of my lawyer friends in the White House. The other thing that I always noted about the Federalist Society is there was always 1 week during the year when you had to sort of dial back your requests from your friends at White House Counsel because they were at all these Federalist events. They were all gone doing Federalist stuff. I originally wanted to be a National Security Council staffer. That was my policy dream job. When I went to the Kennedy School, and then pivoted when I was there. I discovered economic policy, actually started off on health policy, did my master's paper picking apart what we now call Hillary Care, and learned about health policy through that, and then started in fiscal policy. Went down to DC in '94, got my first partisan job working for Pete Domenici on the Senate Budget Committee staff. Right after the first Republican Revolution in November of 1994. Then spent most of my time on the Hill as Trent Lott's economic policy guy. So I really cut my teeth as a legislative leadership staffer, helping enact what we thought were good laws and block bad bills. And we had some degree of success with both. And then I helped Trent Lott help George Bush enact the 2001 tax cut, and was helping a lot with the agenda there. And then in mid-2002, Marc Summerlin was leaving the White House and said, hey, you need to come take my job at the NEC. And so I moved in and spent 5 years as the deputy at the NEC. Everyone likes to pay attention to the last year when I had the director slot. We all thought it was going to be a a nice slow year, so it was safe to move the deputy up. Whoops. But in fact, most of my time and energy, 5.5 years, I really was sort of the behind-the-scenes coordinating guy at the NEC. That's how, that's when you and I did a lot of work together, running lots of conference calls and meetings and, running a policy process. I said that we ran a manufacturing operation and a service operation. We manufactured information for presidential decisions to allow him to make the best decisions he could make, and then we serviced those presidential decisions to make sure that a huge and sometimes sprawling bureaucracy actually did what the president decided they should do.
So in running the NEC, your office was in the executive office of the president, and
I had this nice little windowless closet on the second floor of the West Wing, where I spent all my time, but it was, lots of staffings and policy memos.
Yeah. So turning to the financial crisis, here's how President Bush described it in his book, the one that he didn't plug this morning, which I'm sure he'll appreciate a plug for. But here's what he wrote. He said, in a 2-week period, the government had seized Fannie Mae and Freddie Mac, Lehman Brothers had filed the largest bankruptcy in American history, Merrill Lynch had been sold under duress. The Fed had granted an $85 billion loan to save AIG, Washington Mutual and Wachovia were teetering on the brink of collapse. With so much turbulence in the financial institutions, credit markets had seized up, consumers couldn't get loans for homes or cars, small businesses couldn't finance their operations, and the stock market had taken its steepest plunge since the first day of trading after 9/11. Does this adequately describe the feeling at the time? And to paraphrase a question that was asked earlier, why didn't you see it coming?
Yeah, why'd you miss it? Rule number 1, never disagree with your boss, the president, right? Even in retrospect. No, I think it does describe it. The one additional thing I would add is during that week, sort of the week that started with Lehman filing, the one sort of the triggering event was a money market mutual fund called the Prime Reserve Fund that broke the buck, right? When you put your money into a mutual fund, the deal is you're getting a very low rate of return, but you know that your money is safe. You know that at a minimum you're not going to lose your principal. And what happened was one mutual fund actually had a net asset value below $1, and there were rumors that others were going to start what they call gating. It turns out you can't actually get all of your money out on demand if your mutual fund wants to slow down the outflow. And so there were rumors that some mutual funds were going to start gating. And so what happened was a series of disparate individual failures were triggering the beginnings of a panic. And that's the big shift from pre-September to mid-September, is the shift from a set of individual failures to the beginning of the psychological stages of a financial crisis, which is where people start to lose confidence in the financial system. Right. If you hear that your buddy's mutual fund is gating and someone else's is breaking the buck, you're saying, you know what, I am not getting a good enough rate of return from my mutual fund to take any risk, and so you call up and say, I want all my money. That's all starting to happen. Why did we miss it? I think everybody missed it. In particular, there was one assumption which people weren't questioning, and the assumption was that housing prices would never drop precipitously. It is notoriously difficult to diagnose a bubble of any sort when you're in one. There's a big debate out in Silicon Valley right now where I am. Are we in another tech IPO bubble? And afterwards, we'll definitely know the answer to that, and we'll all speculate as to why half the people were wrong. But when you're actually in it, you don't know it.
So when you're sitting in that small windowless closet, as you've described it, I mean, how can you tell the difference? I mean, what information is coming in that lets you know that we've moved into panic mode as opposed to sort of your general, hysteria in the press? Or what are the signals that you felt coming in that you knew it was really different?
Yeah, I mean, part of it, one of the nice things we have in the economic world is we do have quantitative indicators. Yeah. And so, you can see the volatility indexes that start to bounce around even more. In particular, there's a measure called the credit default swap spreads, which is basically it's the market value of the risk insurance premium. What does the market think is the probability that a certain firm will default in a given time frame? And when you start to see that the market expectations are that all of a sudden the largest financial institutions in the world may not be safe, and when you start to see the market indicators that some of the biggest banks in the world are saying, you know what, I'm not going to loan you money until tomorrow at 9 a.m. because I'm not sure you're going to be around tomorrow at 9 a.m., then you actually have concrete indicators to supplement all of the frantic phone calls you get where anyone you ever know or anyone who they know is trying to get you on the phone saying, you don't understand how bad it is up here.
So you've written a lot about the financial crisis, and in talking about its causes, you said there are sort of three narratives. Can you give us a brief overview of those and tell us which one is right?
So there's a great paper by Elliott and Bailey, Martin Bailey and Douglas Elliott of Brookings Institution, which talks about three narratives. The first one, model one, is it was all the government's fault. This generally has two threads. One is the monetary policy thread, pointing at Greenspan and Bernanke, saying they kept interest rates too low for too long. And then the other is pointing largely at Barney Frank as sort of the symbol for liberal housing policies expressed largely through the affordable housing goals imposed on the GSEs. Model two is one where it's the conspiracy of greedy Wall Street bankers. This is the model where, after a game of golf, Lloyd Blankfein and Jamie Dimon say, okay, let's go, shaft some homeowners. I'll have my people call your people. And then model three is more like that opening scene from the movie The Hangover, which is where sort of all of this wild, crazy stuff happened and everyone's trying to figure out what the various causes were. Model one fits very comfortably in Washington, D.C. for a typical Republican elected official because it's consistent with a lot of our views on, government as causing lots more problems, especially in the economic sphere, than it solves. Model two is very comfortable and very convenient the farther left you are on the policy and political spectrum. Model three, those of us who ascribe to Model three and can point to failures of policy and failures on Wall Street and say it's a messier picture, we find ourselves in a difficult position in terms of the traditional Washington debate, which wants to sort of retreat to our ideological and partisan corners. I think a lot of us who are in that sort of Model three of the view of the world start off actually with an economic issue, which is about global capital flows. You basically had China, India, and the oil-producing nations, their sovereign wealth funds, all of a sudden were awash in capital, and that capital was looking for places to be invested. And it was flowing, what we say, uphill into the US and Western Europe. And we had a financial structure and a financial system which couldn't deal with all of this money coming in, and so the money, water coming into the system, was exploiting the weaknesses in the system, which happened to be, in this case, in the primary mortgage market, the secondary mortgage market, and then in the large financial institutions.
Credit rating agencies?
Credit rating agencies were critical in taking a bad mortgage, and then they slapped on the bad label and transformed that bad mortgage. They added bad information to turn it into a bad financial vehicle. So I think they were even more important than a whole lot of other steps in the securitization process. I still think the crisis would have occurred even if you didn't have the flawed credit rating agencies and even if you didn't have some of those flaws in the secondary mortgage market.
Yeah. So I think the panel that the topic of discussion that we've been charged with discussing is the 2008 financial crisis and the rule of law. So I'm going to press you a little bit in a few minutes on some of the decisions that were made during your time in 2008. And there are people who have been critical from all sides of the political spectrum about those decisions and whether they're consistent with the rule of law. So I thought maybe we'd take a minute just to kind of agree on a definition of rule of law. And then
Not a lawyer.
So first, I think it means that the laws have to be clear, They have to be publicized and stable and just and applied evenly to protect fundamental rights, including the security of persons and property, and that the process by which those laws are enacted needs to be enforced in a way that is accessible and fair and efficient. I think probably the most succinct description of it may be from Hayek, who said that the rule of law is the opposite of arbitrary government. So, fair enough?
I'm not going to dispute it.
Yep.
I know better than to dispute a smart lawyer on what's the right definition of rule of law. What I will do is say that the job that I was operating in, I thought of as an engineering type job. It was a policy design and then later a policy implementation job where we were trying to design policy systems that worked subject to a bunch of constraints. So I'll take that as a good and important binding constraint.
All right, deal. So we'll run through 5 different decisions that you were confronted with. The first I'll describe as picking and choosing between financial institutions. So towards the middle of the summer, Indy Mac failed, and then Bear Stearns survived, but Lehman Brothers did not. Within 2 weeks, AIG, after Lehman Brothers collapsed, got an $85 billion loan, and Goldman Sachs was allowed to restructure as a bank holding company to get Fed protection. Was there a clear set of rules that led to what from the outside seemed like disparate and often conflicting outcomes?
Yeah. First thing is, let me just emphasize a process point, which I think is an important difference in the way that the Bush administration operated and the way the Obama administration operated. And it was about delegation of authority. Specifically, there were 3 people. It was Hank Paulson, Ben Bernanke, and then Tim Geithner, who at the time was running the New York Fed, it was really the 3 of them who were making the key operational decisions. Note that only one of those 3 actually technically reports to the president, right? President Bush appointed Ben Bernanke to his job, but once he had that job, he was independent. And of course, Geithner doesn't report to the president. And what the president said to Hank is, come to me when you need policy judgments, when you need support, keep me and my team in the loop. But in terms of implementing those policy principles with respect to specific firms, I would prefer that not be the White House staff and it not be the president who's making the decisions on should we do this with Bear Stearns, should we do this with AIG. He wanted to delegate that authority because he didn't want the appearance of impropriety in that those individual decisions were being made in the structure that is perceived to be more subject to political pressures, as opposed to when you saw President Obama later doing the decision with General Motors, where in fact the White House staff was clearly bragging through the New York Times. The president made the decision on GM. The president fired Rick Wagner. That really set me aback. Not that he actually made the decision, but that they were so comfortable taking ownership of it. On your specific question, the decisions on the individual firms, so on Bayer, on Indy Mac, and AIG, and all of those, I describe that as the ad hoc case by case, the ad hoc ex post portion of the crisis. And what I mean by that is that in each case, the way the decision was being made was wait until the firm is clearly on the verge of failure. Then evaluate whether that firm is so interconnected with some other part of the system, what economists would say there's a huge potential negative externality to the firm's failure, that the policymakers are extremely uncomfortable with allowing that firm to fail. Right? If Best Buy files for Chapter 11, I mean, it's tragic, but it's not a policy concern. If a financial firm fails and that financial firm's failure, if done incorrectly, will cause a dozen other medium and large financial firms to fail, then all of a sudden it becomes a policy concern. So Indy Mac was failing. Indy Mac was a medium-sized to large firm, but the Bernanke, Paulson, Geithner, and their teams basically concluded we're not concerned about the side effects of that failure, and so we don't have to intervene. In the cases of Bayer and AIG and the other interventions, the judgment call that they were making was because of the structure that we had in place beforehand, because there were these linkages, there were the negative externalities, so that was the guiding principle. Now, in terms of the mechanics of how it was done, the mechanics were clearly just designed, I mean, it was duct tape and baling wire in a lot of cases, where they were doing it on a case-by-case basis. So, for instance, if you look at the capital structure of a firm, and you look at where the Fed intervened in the capital structure in Bear, where they did in AIG, where they did in the various transactions, it's all over the map, which is, as a long-term policy matter, sending horrible signals to investors, right? Because investors then don't know, where do I want to put myself in line, because the government might hop in line in front of me. So that's clearly something that ex post you really didn't want to have happen, but because they didn't have a systematic authority which allowed them to intervene in a nice, clean way and say, this is where we're coming into the capital structure, or here's the set of rules which will define the firms which we will intervene with and the firms with which we will not, it was doing the best they could.
So, yeah, well,
so yes, inconsistent, and yes, necessary.
So when you think about, we'll get to some lessons learned later, but just in terms of the decisions that, is it fair to say it was a relatively small group of people who were making the final calls on which institutions were going to get the investments?
Yeah, it was Hank, Ben, and Tim.
Yeah.
And then, two were, they each had one to three key, a general counsel and then some smart numbers, accounting, or a policy person.
Great. So one of the big piles of money that was being used at the time is what I'll call the second decision, Tarp, right? So the Emergency Economic Stabilization Act of 2008 was enacted on October 3rd. And it was, I think, perceived, you tell me if it's right or wrong, largely in response to the subprime mortgage crisis, that the Secretary of Treasury was given $700 billion to purchase distressed assets, especially mortgages and mortgage-backed securities, and supply cash directly to the banks to help solve the liquidity crisis that was tied up with the housing problem. So you've described this sort of big pile of cash that was sort of handed over to this small group of people, but you've also written about how that was necessary. Because you were on this ad hoc case-by-case basis as opposed to something more systemic, that some shock and awe was really needed. What did you mean by that shock and awe in the context of an economic crisis?
Yep. In the case-by-case advantage, in the case-by-case situation, and where you're intervening only where you're evaluating whether or not to intervene only when the firm is on the brink of failure, there is a very distinct advantage to that, which is you are minimizing one type of error, right? You are much less likely to waste taxpayer funds and intervene in firms where you've made the judgment call that this firm can fail. You're not going to be intervening in lots of cases where you don't think you need to, right? The downside of that case-by-case version is, since you don't know how deep and how wide the problem is, you may just have a sequence of individual failures going on forever, or it may start to snowball, as we saw in mid-September. What we did in late September and then into October is basically a 90 or 180-degree pivot to saying we're trading that type of error for the other type of error, right? Which is we're now going to go, and this is in large part triggered by the panic, even more than by the reevaluation of how deep and how wide the problem was, which is we're now going to say we're now going from potentially undersolving the problem but not wasting taxpayers' money and not intervening in cases of firms that don't need it. We're flipping to the other side, which is we're going to be intervening in many more cases, but we're going to reduce the probability that the panic gets out of the control. We're going to reduce the probability that we've undersolved the problem.
And did you see that with that government backstop or potential government backstop in place that firms actually increased their risky behavior?
Yes, and there are two dimensions of it. One is you are going to be putting money in places where when you were doing the case-by-case basis you might not have otherwise done.
Right.
which is probably good for the system, but there may be some firms that really don't want the money. Richard Kovacevic, I mean, is very intense about this in retrospect, and he says, look, the government forced me to take this money. Yes, they were, and they were doing that because they thought it was healthy for the system. Sorry, ask the question again.
Promotion of risky behavior when you have a government fund there, that if you get to the brink, there's a net there.
So the other thing, the shock and awe, or I was referring to Tarp as break the glass, right? In case of emergency, break glass. The other part of it was the psychological effect, was because you had the panic starting, and a big part of it was the number, was the $700 billion number, and then the announcement of it. Basically caused everybody who was saying, oh, I'm not sure I'm going to lend money to that other big bank tomorrow night. They said, whoa, federal government's coming in with $700 billion. Holy mackerel, that's a lot of money. Okay, I'm not quite as worried as much. And so everybody calms down. They know that they're there. And it wasn't just the TARP. It was also Ben Bernanke turning on all the spigots to pump liquidity into the system, which, by the way, I have my own views about QE1, QE2, QE3, which are later, but there's no real debate that during a crisis, the Fed's job is to flood the system with liquidity to make sure that you stem that panic while it's happening. I think both of those things were absolutely necessary at the time, and they worked. It was sort of the initial fire suppression that then gave you time to allow conditions to start to return to normal.
Decision 3, the auto bailouts. So in December of that year, the House voted in favor of a $14 billion bailout for GM and Chrysler. But the very next day, the Senate actually voted that deal down.
Filibustered.
All right. So didn't get the votes they needed. So not law, not through the congressional process. But the president, Secretary Paulson, the economic team ended up less than a week later, or about a week later, putting about $17.5 billion into those same entities through TARP. So how could you have used TARP in light of the congressional rejection of the auto bailout? And were there discussions? Were the lawyers involved? How do you get to that place?
Lawyers were involved in everything, which was good. Yes, so our first choice was that if we were going to intervene in the autos, we wanted a new pot of money authorized by Congress. That was definitely the right way to do it. We had the TARP statutory authority. There was a catch-all provision in the TARP law which said, you can use it for X or Y or Z or anything else that any other financial entity which the secretary and maybe the Fed chairman deem is necessary to stabilizing the financial system. So that was sort of the legal authority to do it. But the policy judgment was, look, Congress authorized the $700 billion of funds. They clearly didn't have in mind the auto industry, right? We think it may be necessary, so that's why we went to Congress. We convinced House Democrats. We did not convince Senate Republicans. Actually, we did not convince enough Senate Republicans. I tell my students on this that they are insufficiently cynical about this one. The reality that we saw is there were some Senate Republicans who voted against cloture, so they voted against the legislation happening, anticipating that President Bush would then use his fallback option, which was to use the TARP money, which would then allow this senator to go out and say, I stood by my free market principles and voted against bailing out the auto companies while the auto companies still got bailed out over here.
In Washington, that would never happen.
Never happened. So it allowed certain elected officials to maintain their own intellectual purity while still getting the desired policy result that they wanted. But look, it's this is one where if you're free market in terms of your thinking, you can go either way. And there was and still is a very significant debate about the appropriateness of that. President Bush made a judgment call, that it was the right thing to do.
Yeah. So a few minutes ago, if I understood you right, you were talking about the differences in how President Bush handled the auto bailout versus President Obama. Mm-hmm. And so it was help us find a limiting principle in what you did, because you might take the view of sort of in for a penny, in for a pound, right? So once you're that deeply involved in the auto companies, why not go those extra steps that the President Obama did, like resecuring, basically turning the bankruptcy process on its head, having unsecured creditors like unions receive more money than the secured creditors who actually had collateral, actually had real debt instruments. How do you, once you're in?
Yep. Okay. So first thing on the autos is one of the defining features of the auto situation from our perspective was that it was happening, less than a month before the end of the administration. And so I think that was very significant in that President Bush would say to us, look, my successor, I supported his opponent, but we want him to be successful. My successor is coming in with a financial crisis. He's going to get his first real terrorism briefings. He's going to be dealing with all of these huge issues. I want to give him the breathing space. I want to give him some time so that he doesn't have to deal with, so that he can make whatever decisions he thinks is appropriate on GM and Chrysler. And I think President Bush knew, and we certainly all knew, that that meant that we were ceding some decision-making authority to his successor and to our successors. So we referred to the Bush loan decision as the bridge to Obama. We were buying 3 to 4 months of time to allow him to get his footing, and we were teeing it up so that we were pretty sure we knew what direction the Obama team would go. We made the loans. We set up conditions. We said you can keep your loan only if you can prove to the government that you have a restructuring plan under which you will be financially viable, meaning that you will have a positive net present value without ongoing government loans, that you will make changes to your dealers, to your labor contracts, to all of these different things. That was as far as we were willing to go in terms of telling the companies what to do. And we thought that was appropriate because what we were saying is these are conditions for the extension of a loan. We anticipated that the Obama administration would then take those conditions, maybe tweak them a bit. Right? But the other big principle that we had was it was not our job to restructure GM and Chrysler. It was our job to do what the market would not do, which was to provide a short-term loan with stringent conditions. But it was not our job to restructure GM and Chrysler, and we couldn't have in 4 weeks. The fundamental difference with the Obama administration is they brought in Steve Ratner and basically said, you're now running GM and you're now running Chrysler. And they had him and his team, in effect, supplant the decision-making authority of the board and make those decisions. Now, that was the part of what the Obama team did that really chafed with me. Yeah. And one of those decisions, of course, was going through this Section 363 bankruptcy process, upending it, prioritizing organized labor. They have their arguments for why that was necessary. I don't buy them. From my standpoint, they did what we anticipated right up to the point where they crossed into this new threshold of the government actually running the restructuring of a firm. Now, I'll give them, in their defense, neither GM nor Chrysler's management and leadership had actually demonstrated that they had any ability to make these decisions up to this point. After all, they put themselves in this position. But that was really unusual and shocking to me when I saw them do it.
Decision 4, GSEs, Fannie, Freddie. So you were pretty well known for not being huge fans of at least certain parts of how they were set up, in the sense that...
Nor were they of me.
The sense that, right, they were essentially Fortune 500 companies that had government backing, which of course allows for riskier behavior than other competitors or former competitors in the marketplace would be allowed to take. I mean, why wouldn't you look at their impending collapse as a golden policy opportunity to achieve what hadn't been achieved before?
Yeah, I thought the best comparison is a friend years ago had said that they were the modern day equivalent of the British Tea Company. They had all of the benefits of the sanction of the crown and of the government imprimatur, and then they had all the benefits of being a privately owned company. Yeah, look, there were a bunch of us on the Hill and then in the Bush White House who had been pushing GSE reform for years. with the strong support of President Bush, he and then we on his behalf were considered radical before the financial crisis. And there were national journal stories, articles written about how President Bush had, in effect, taken himself out of the GSE reform debate because his proposals were so far outside the, I might add, bipartisan consensus on Capitol Hill that Fannie and Freddie were doing fine just the way they were. There was a group, there was a subset of economic conservatives on Capitol Hill who were pushing for parallel reforms to where we did. But it wasn't just the Democratic Party, it was probably half to two-thirds of the Republican Party that was fine with the status quo. We did push. We were unsuccessful. We were proven right, but we were proven right only when the firms were failing. And so, in fact, we were finally able to overcome that legislative resistance only when it was too late to do any preemptive good, and instead when you had the authority, when the firms were on the brink of failure in the summer of 2008.
So,
By the way, it's not very satisfying to be proven right too late.
So as you look at each of those four decisions that we've talked about briefly, and you could spend entire conferences on each of those decisions, the theme that kind of runs through them, the common decision, is this philosophy of too big to fail. And a few years out, as Americans were polled about the decisions that were made during the financial crisis, you always get short descriptions of everything, the bailouts. 71% of the public thought that the government should have let banks who were too big to fail. Does the public have that one wrong? And if the president had made the case against government action and he had taken a hands-off approach, I doubt he would have gotten a free pass, right? So why so politically unpopular?
Kevin Warsh and I had to go do the first round of trying to convince the House Republican Conference that they needed to vote to write a $700 billion check to bail out Wall Street bankers, otherwise the economy might collapse. Right? That's not an attractive sales pitch to make, either to the American people or to their elected representatives.
You must be very persuasive.
I was terrible. It was traumatic. I was not effective. Yeah, I like to say that Tarp is the most successful financial policy that no member of the House or Senate will admit having voted for. It worked. I think that it was necessary. But to test that, the problem is it's the counterfactual problem. Right? To test it, what you have to do is you've got to rewind time. You've got to then play the tape forward without having enacted Tarp, without taking the Fed actions, allow the firms to fail, and then say, let's imagine what would have happened. What we found was that the policymakers were risk averse. Now, I had the reputation of being one of the people who would have been least likely to be willing to support some kind of intervention, and there were a couple others of us who you would have typically expected to argue against it. We were convinced by the evidence and by what we were seeing qualitatively and quantitatively that the probability of a catastrophic systemic failure, a collapse of the system, not just of individual banks, was a high enough probability that it made sense to intervene. For those of you who disagree, I guess my question would be, imagine you're the Secretary of the Treasury. Imagine that your staff come to you and they say, I'll make up a number, there's a 20% chance, if we don't do this, there's a 20% chance of a global financial collapse that will result in economic disaster on the level of the Great Depression. Assume that you're a skeptic. Assume you think they're wrong. Assume that you think that it's only a 5 to 10% chance. What do? Are you willing to intervene in that case where it's a 5 to 10% chance? One other thing on too big to fail. A more precise label for it is too big and too interconnected to the rest of the financial systems for policymakers to be willing to allow it to suddenly fail. Right? That is the reason, that's the actual source of the negative externality that causes the need for interventions. The easiest example of this actually were Fannie Mae and Freddie Mac. Because the financial rules and the financial structure we have in place give a privileged status to what's called agency debt, right? Debt issued by Fannie Mae and Freddie Mac, it meant that if you were running a local community bank here in Dallas, you would not be allowed to concentrate all of your balance sheet, right, in the debt issued by IBM or Hewlett Packard or Frito-Lay, right? The rules would require you to diversify, but you could put it all into Fannie and Freddie debt. And in fact, a lot of financial firms in the US and around the world did that. Now that was the problem then was not coming in and saying, if we don't bail out Fannie and Freddie's debt, will cause all of these small and medium-sized banks to fail. The policy problem was on the front end. The policy problem was the rules which were in place, which created the incentive to allow these bankers and to allow all of these others to take risks that they shouldn't have been taking.
Yeah. So absolutely get, standing in your shoes, sort of the prevention of the catastrophe. I think the president said, I was not willing to be Herbert Hoover, right? So if we're almost with you, can you help us articulate a conservative, rule of law-based philosophy that would help you to understand how you manage the economy and govern in a time of crisis like that?
Yeah, so I don't like the phrase manage the economy because I don't think we ever do that. Yes, so I think in that case, what you're doing is what we were doing is we were trading problems, right? And the analogy that I use is the surgical operating room from the TV show MASH, right? Where we had absolutely critical problems that we thought were life-threatening or system-threatening, and then you'd come up with a solution to it. And then you'd come up with a solution, you'd say, but if we do this, it's going to significantly increase long-term moral hazard. And you say, great. Look at those problems. I am happy to trade, right? If I reduce the risk of a global systemic financial collapse by 5 percentage points in exchange for increasing long-term moral hazard, there's no question in your mind you make that trade. So you're making those trades, you're doing those things, and I think it is in large part the result. A lot of people want to blame the people who were in place making those decisions at the time. I instead focus on the structure that we had in place that put us in the position where our options were choosing between things that we didn't want to do, intervening at different places in the capital structure, increasing long-term moral hazard, and where your only other alternative is what looks like a catastrophic outcome. And so then the more important question is sort of where are you going forward, and have you mitigated the risks that those things will happen in the future? And unfortunately, I think the answer is not entirely.
So report card on how much of the lessons learned we've had in Congress and with this current administration in fixing those things that we know.
In my view, the good part of what's been done is that the large financial institutions are required to hold much higher amounts of capital and much greater amounts of liquidity. The leverage problem has been, I don't want to say largely addressed, has been significantly addressed. So that cause of the crisis, I think, is the one where they've made the greatest degree of progress, and then we can quibble over whether the numbers are right. The problem is that I refer to it as the arrogance of Dodd-Frank. I think that a lot of the mindset that resulted in the post-crisis law is one which said, if only we put the right people in place at the Fed and the New York Fed, if only we give them more power, more tools, we have more supervisors, we give them more information, those people in government will be able to see the next crisis coming. They will see the next firm failing. They will be able to get in there and take preemptive action or force the firm to take preemptive action before the next crisis happens, and we will prevent it. It's entirely depending on early warning systems and preventive action. To which my reaction is, okay, I'm skeptical that that's all in fact going to work. I'm skeptical that you're as smart and as competent as you think you are. right? But suppose that doesn't work, and suppose the capital and liquidity buffers don't work, and suppose you end up in the tail risk scenario again, where you have Citigroup, a global firm, right, with tens of billions of dollars scattered all over the world. Suppose that is failing again. Do you now have the authorities that you need, right, with whatever set of rule-based systems or person-based systems you want to resolve that firm, such that you don't have to go through a repeat? And I think the two big failures of Dodd-Frank are they put too much emphasis on the front end and they have too much confidence. And then the really scary thing is if you get into the back end scenario, they actually in some cases have less authority than they did in 2008. And so they may have to go through even worse and more painful contortions than we did.
Yeah, and if I could sort of step out of the role of question asker, I mean, I'd add a third to that, which is just the basic concept that you can regulate your way, sitting in a general counsel chair, that you can regulate your way with a set of impenetrable rules and processes that you impose upon private entities and expect that to enhance the kind of good, solid, moral judgments that have to be made on a day-to-day basis of running the business.
Yeah, I think the best thinker on this topic is a guy named Andrew Haldane at the Bank of England, who is an advocate for simplicity. And in particular, simplicity. And what he's saying is that what we've done is we've layered on complexity and complexity and complexity and complexity in terms of regulating these large financial institutions. It's sort of like the tax code, right? One layer on top of another. And he argues that if you have, in fact, much simpler, more basic rules, they're easier for everyone to understand. They create the proper incentives. Now, those rules may have to be a bit more meat cleaverish, right? And you will trade having the mess of complexity for these simple chops, but that may be better for the system in the long run, and I'm convinced by that.
Yeah, so I'm going to use my point of personal privilege, and I'll leave you with the last word, but raise one last topic for you before we head to lunch. So you're in a room, I'm looking around, and I see some really good lawyers in this room. So I'd love just to kind of hear any stories that you have about your interactions with lawyers in the White House or in the Treasury Department, and were there moments where there were just deep tensions between sort of what the rules were in place and the desired action, and any general advice you have for lawyers as they're advising clients managing through major crises?
Yeah, I was a huge fan of my friends in White House counsel in particular, and then I got to know some of the agency counsels and the OMB guys and gals as well. I think part of it is because we were sort of the economic conservatives in the policy operation, and all the White House counsel folks were pretty conservative as well, so that was sort of fun. But then just working with them, and I think part of it was just we had a good team operation. What I needed from the lawyers a lot was I needed them to be patient with me and rewind to stuff that, because sometimes you lawyers talk in dolphin blips to each other, and they're, you use terms and you use, there are certain things that, of course, everybody learned when they were a 2L. And you need to take someone like me and say, okay, here's what you got to understand about the basic principle of contracts, and here's why that then gets expressed in a certain kind of thing. When people were patient with me and would walk me through that and would explain to me why they were telling me, no, you can't do what, Keith, you think we absolutely have to do, it helped that. And then at the same time, when they would come to our policy meetings, when they would grab me afterwards and say, explain to me why you think we need to, or why Secretary so-and-so thinks we need to get the following outcome, because maybe I can find a better path to it. That was very helpful. And when I found the lawyers who would work with me in that way, it was incredibly productive, because we could start to they could help me translate between their complex technical world of legal stuff, and then as I was translating between the economics and all the political and legislative and other policy people.
Well, thank you very much. I have to tell you, the fact that you've been able to take a simple milk lawyer and get him to understand a little bit about the financial crisis speaks to great testament about the clarity of thought and the courage of decision-making that you brought to the situation. So thanks so much for joining us. It's been a pleasure working with you over the years and hearing from you today. So terrific job. Thank you.
Let's go have lunch.